So as we start the second part of this lecture, we're going to look at another exercise. Aspen Ski Resorts has 100 employees, each working 40 hours per week and earning $20 an hour. Although the company does not pay any health or retirement benefits, one of the perks of working at Aspen is that employees are allowed free skiing on their days off. Federal income taxes are withheld at 15% and state income taxes at 4%. FICA taxes are 7.65% of the first $118,500 earned per employee and 1.45% thereafter. Unemployment taxes are 6.2% of the first $7,000 earned per employee. Our job is to compute the total salary expense, the total withholdings from employee salaries, and the actual direct deposit of payroll for the first week of January. Then we'll compute the total payroll tax expense Aspen Ski Resorts will pay for the first week of January, in addition to the total salary expense and employee withholdings calculated in Requirement 1. And then last, how would Aspen Ski Resorts account for the free skiing given to the employees on their days off? What do we do with that? Do we have to do something with it? So let's look at the first part. We had 100 employees, $40 an hour at $20 per hour would be $80,000. So our total salary expense is $80,000. Now, the federal taxes are withheld flat across the board, 15%. So $80,000 at 15%, we're going to have $12,000 in federal tax. State tax is at 5%. So state income tax, that will be withheld from the employer's salaries. Employees' salaries are $4,000. And then the FICA withholding of 7.65% on that $80,000 is $6,120. That is withheld from the employee's pay. So the 80 gross minus the various withholdings, the 12, the 4, and the 6120, total $22,120. The net, if that was the only thing that would be withheld from their paychecks, is $57,880. Now the next requirement asks us how much does the employer need to have withheld for various payroll tax expense. They have to match the FICA, so the 80,000 times 0.0765% or 6120, they have to pay also. And then the unemployment taxes of 6.2% on the 80,000 would be 4,960. So the total payroll tax expense would be 11,080. Now, in regards to the free skiing, what does the company need to do? Nothing. No additional costs are directly incurred by the company to provide this benefit. Therefore, there is nothing they need to do. Airline employees who get to fly for free, there is nothing that the airline needs to do. It is a free benefit that does not have a cost. Next, we're going to look at the accounting for other current liabilities. So deferred revenue refers to a liability created when cash is received in advance of a sale or service. Companies selling products subject to sales tax are responsible for collecting the sales tax directly from customers and periodically sending the sales tax collected to the state and local governments. The selling company records sales revenue in one account and sales tax payable in another. Also, the current portion of long-term debt is the amount that will be paid within the next year. Management needs to know this amount in order to budget the cash flow necessary to pay the current portion as it comes due. Investors and lenders also pay attention to current debt because it provides information about a company's bankruptcy risk. Let's look at each one of these in a little more detail. So United Airlines sells tickets and collects the cash price several days, weeks, and sometimes months before the actual flight. When does United record the revenue? When it sells the ticket or when the flight actually takes place? This slide provides the answer in United's disclosure of its revenue recognition policies. As you see here, it's when the transportation is provided is when the revenue is recognized. How do companies account for the cash they receive in advance? We initially discussed deferred revenues in a previous chapter, but let's look at an example. Assume Apple Inc. sells an iTunes gift card to a customer for $100. This is recorded with the first entry, cash, debit of $100, deferred revenue, a credit for $100. As you can see, Apple records the receipt of cash but does not credit sales revenue. Since the music has not been downloaded yet, the company credits deferred revenue, which is a liability account. Think of it this way. Already having collected the cash, the company now has the obligation to provide a good or a service. Now, when the customer purchases and downloads, say, $15 worth of music, then Apple records the second entry. As the company earns revenue from music downloads, it decreases the liability, the deferred revenue, which means it's going to debit that deferred revenue, and it increases sales revenue. The customer has a balance of $85 on his gift card, and Apple has a balance in deferred revenue, which is a liability account, of $85 for future music downloads. Most states impose a state sales tax, and many areas include a local sales tax as well. Now, some states don't have sales tax, but most do. Each company sells products subject to sales tax, is responsible for collecting the sales tax directly from customers and periodically sending the sales taxes collected to the state and local governments. Now, the selling company records sales tax in one account and sales tax payable in another account. When the company collects the sales tax, it increases or debits cash, and it also increases or credits sales tax payable. Let's look at an example. Suppose you buy lunch in the airport for $15 plus a 10% sales tax. So the airport restaurant records the journal entry as a debit to cash for $16.50. The credit is the sales revenue, the $15, which is your meal. The sales tax payable is $1.50, which is basically going straight to the state and local government. Remember, sales tax collected from customers are not an expense. They represent current liabilities payable to the government. The current portion of long-term debt is the amount that will be paid within the next year. Management needs to know this amount in order to budget the cash flow necessary to pay the current portion as it comes due. Investors and lenders also pay attention to current debt because it provides information about a company's bankruptcy risk. long-term obligations are reclassified and reported as current liabilities when they become payable within the upcoming year or the operating cycle, whichever could be longer. So let's look at an example here. Apple Inc.'s the #1 online music retailer through its iTunes music store. Apple sells iTunes gift cards in $15, $25, and $50 increments. Assume Apple sells 21 million in iTunes gift cards in November, and customers redeem 14 million of the gift cards in December. Let's record the advance collection of 21 million for iTunes gift cards in November. We'll then record the revenue earned when 14 million in gift cards is redeemed in December. And then what is the ending balance in the deferred revenue account? So this is going to be very similar to what we just looked at. So the first one, when the advance collection of 21 million in gift cards, we're going to debit cash for 21 million. We are going to credit deferred revenue of 21 million. When 14 million of gift cards are redeemed, we are going to debit, which is decreasing that liability of deferred revenue for 14 million, and then crediting sales revenue, because now those that portion is actually earned. It is revenues that we can record. So we debit our deferred revenue of 14 million, we credit our sales revenue of 14 million. Then the ending balance in the deferred revenue is going to be what we started with, the 21 million, which is deferred revenue. A liability has a normal credit balance. So we started with 21 million, we debited 14 million, which gives us an ending balance of $7 million. Southwest Airlines has total borrowings of $2,692,000,000. Why am I not getting that right? $2.692 million. Of that amount, $258 million is due in the next year, and the remaining $2.434 million is recorded as long-term debt. $2,434 million. I'm so sorry. $2,694 million is the borrowings. $258 million of that's due in the next year, and the remaining $2,434 million is recorded as long-term debt. Now, in Southwest Airlines' balance sheet, the company records the $2,692 million in current and long-term debt as shown here. The current portion of that debt, which is due within the next year, we show as a current liability, since we know it needs to be paid in the current year. We need current funds to pay that current debt. The difference, the remaining $2,434, will be classified as long-term debt. The key here to remember is the current portion of long-term debt must be classified as current debt. So let's look at another question. This one talks about a home improvement store sells some merchandise to a customer. The price of the merchandise is $200 and the sales tax rate is 6.5%. How much would be recorded in the sales tax payable account? So would that be A, $13, B, $213, C, $130, or D, none of the above? The sales tax payable would be $200 times the sales tax rate of 6.5% to equal $13. Many companies are involved in litigation disputes in which the final outcome is uncertain. So in this next section of the lecture, we're going to discuss how to report these uncertain situations, which we call contingencies. We're going to apply the appropriate accounting treatment and learn what the appropriate accounting treatment would be for contingencies. Excuse me. Now, a contingent liability is an existing uncertain situation that might result in a loss depending on the outcome of a future event. Examples include lawsuits, product warranties, environmental problems, and premium offers. Philip Morris's tobacco litigation, Motorola's cell phone warranties, and British Petroleum's environmental obligations, along with United's frequent flyer program, are all contingent liabilities. This illustration here provides a summary of the criteria for reporting a contingent liability. Now, a contingent liability is recorded only if a loss is probable and the amount is reasonably estimated. It's really important you remember probable and the amount can be reasonably estimated. A contingent liability is recorded only if a loss is probable and the amount is reasonably estimable. Now let's take a look at what a disclosure would look like. So if it's reasonably estimable and probable, we're going to record the liability. If it's reasonably possible and reasonably estimable, we're going to have a disclosure. If it's probable but we can't reasonably estimate the amount, we're going to have a disclosure. And if it's reasonably possible but we can't estimate the amount, we're going to have a disclosure. If it's remote, we don't need to do anything about it. It's really important that you know in what situation we need to report it and in what situations we need to disclose it. So this slide provides excerpts from the disclosure of contingencies made by United Airlines. United has certain contingencies resulting from litigation and claims incident to the ordinary course of business. Management believes, after considering various factors, including legal counsel, the nature of contingencies to which we are subject, and prior experience, that the ultimate disposition of these contingencies will not materially affect the company's consolidated financial position. Contingency for frequent flyer program miles. United's Mileage Plus frequent flyer program awards mileage credits to passengers who fly on United, United Express, and other airlines that participate in the program. When a travel award is attained by a Mileage Plus member, we record a liability for the estimated cost of such awards. Let's look at an exercise. Pacific Cruise Lines is a defendant in litigation involving a swimming accident on one of its 3 cruise ships. So for each of these scenarios, we're going to determine the appropriate way to report the situation. Explain your reasoning and record any necessary entry. 1 is the likelihood of a payment occurring is probable and the estimated amount is $1.3 million. Sounds like that's going to need to be reported. It's probable and it's reasonably estimable, so it has to be recorded as a loss with a credit to a liability account contingent liability. Number 2, the likelihood of a payment occurring is probable and the amount is estimated to be in the range of 1.1 to 1.6 million. Well, here we would show the minimum amount, 1.1 million, and disclose the nature of the contingency and disclosure notes. So we would have a debit to loss of 1.1 million, a credit to the contingent liability of 1.1 million. Next, the likelihood of a payment occurring is reasonably possible, and the estimate amount is 1.3 million. Well, what did it say? If it's reasonably possible, we're not going to require a journal entry, but we're going to have to make full disclosure in a note to the financial statements to discuss the contingency. Then last, the likelihood of a payment occurring is remote. While the estimated potential amount is 1.3 million, what do we know if it's remote? We don't need to do anything. Disclosure is not required. Okie doke. Let's assume Dell introduces a new laptop computer in December that carries a 1-year warranty against manufacturer defects. Based on industry experience with similar product introductions, Dell expects warranty costs will be an amount equal to about 3% of sales. New laptop sales for the month of December are 1.5 million. The warranty expense is recorded with this first entry. 3% of the 1.5 million, a debit to warranty expense for $45,000, and a credit to the warranty liability for $45,000. Now, when customers make a warranty claim and Dell incurs costs to satisfy those claims, the liability gets reduced. Let's just say a customer makes a warranty claim that costs Dell $12,000 in January of the following year. So the journal entry to record the payment for warranty work is shown here as a debit, a reduction of the liability, and a credit to cash. Anytime you need to calculate a balance, it's often helpful to make the T account as shown here on this slide and record the transactions. The balance in the warranty liability account at the end of January is going to be $33,000. Now that's the $45,000 initial liability, then the debit to warranty liability of $12,000 gives us a balance here of $33,000. Some students think the balance in the warranty liability account is always equal to the warranty expense. Remember, the warranty liability account gets increased when the estimated warranty liability is recorded, but then it just starts getting reduced over time by those actual warranty expenditures that occur. Let's look at another problem here. This problem, exercise 8.13, computer wholesalers restores and resells notebook computers. It originally acquires the notebook computers from corporations, upgrading their computer systems, and then it backs each notebook it sells with a 90-day warranty against defects. Based on previous experience, computer wholesalers expects warranty costs to be about 6% of sales. Sales for the month of December are $600,000. Actual warranty expenditures in January of the following year were $13,000. So does this situation represent a contingent liability? Why or why not? Record warranty expense and warranty liability for the month of December based on 6% of sales. record the payment of the actual warranty expenditures of $13,000 in January, and what's the balance in the warranty liability account. So this is going to be very similar to just the problem we just looked at. So it expects the warranty cost to be about 6% of sales. Does this situation represent a contingent liability? Yes. It's probable there are going to be costs that are going to be incurred, and we know the 6% is a pretty reasonable estimate of what it's going to cost. So yes, we would record this contingency. It asks us, how would we record it? Well, the sales times 6% gives us a warranty expense of $36,000, a credit to warranty liability for $36,000. Remember also here, we are recording this warranty expense now because we're recording it in the period that we had the sales. Remember, that matching principle is why we're doing this. Next, when the $13,000 was paid, we're going to debit. I'm sorry, this slide does not show that. We're going to debit the warranty liability for $13,000, and we will credit cash for $13,000. Then the balance in our account, we started with $36,000. We had a payment of $13,000, so we end up with a balance here of $23,000 in the account. Which of the following statements is true with respect to warranty liabilities? A, warranty expense needs to be recorded in the period the warranty repair is made. The warranty expense account balance will always equal the warranty liability account balance. The warranty liability account is debited as actual repairs are made, or D, all of the above are true. What do you think? We know the warranty expense is going to be made in the period the sales occur. We have the warranty expense associated with that liability, so that's not true. The warranty expense account will always equal the warranty liability account. We know that's not true. C, the warranty liability account is debited as actual repairs are made. Here's another one. During its first year of business, Oceanic Inc. has sales of $300,000 and pays warranty claims of $10,400. Oceanic offers a 1-year warranty and anticipates that warranty costs will be 5% of sales. What's the balance in Oceanic's warranty liability account at the end of the first year? The liability account is going to be the $300,000 at 5%, $15,000. But it had claims of $10,400. Since payments of $10,400 were made during the year, then we would have the liability account being the $15,000 that was initially put in minus the $10,400 claims made against it, which would be $4,600 as the balance. Now, a contingent gain is an existing uncertain situation that might result in a gain, which often is the flip side of contingent liabilities. So in a pending lawsuit, one side, the defendant, faces a contingent liability, while the other side, the plaintiff, has a contingent gain. We do not record contingent gains until the gain is certain. The non-parallel treatment of contingent gains follows the same conservative reasoning that motivates reporting some assets, such as inventory, at the lower of cost or net realizable value. So until we have it in our pockets, we're not going to record it for conservative purposes. Unlike contingent liabilities, contingent gains are not recorded until the gain is certain and it is no longer a contingency. Now we're going to look at some liquidity ratios. Liquidity refers to having sufficient cash or other current assets convertible to cash in a relatively short time to pay currently maturing debt, bills. Because a lack of liquidity can result in serious financial problems or potentially bankruptcy, it's really important managers as well as outside investors and lenders maintain a close watch on this aspect of a company's well-being. So we're going to look at 3 liquidity measures. One is called working capital, one is the current ratio, and then the acid test ratio. All 3 of these are going to measure they're going to measure liquidity, and we're using current assets and current liabilities in order to measure these liquidity ratios. Now, working capital refers to the difference between current assets and current liabilities. Working capital answers the question, after paying all our current obligations, how much money do we have left? A large positive working capital is an indicator of liquidity, whether a company will be able to pay its current debts on time. However, working capital is not the best measure of liquidity when comparing one company with another, because it does not control for the relative size of each company. Now, the current ratio is calculated by dividing current assets by current liabilities. As a rule of thumb, a current ratio of 1 or higher often reflects a pretty acceptable level of liquidity. Recall that current assets include cash, current investments, accounts receivable, inventory, prepaid expenses. So a current ratio of, let's say, like 1.5 indicates that for every dollar of current liabilities, the company has $1.50 of current assets. Now, the higher the current ratio, the greater the company's liquidity. But we should evaluate the current ratio like other ratios in the context of the industry. So each company operates in a certain sector or industry. And while not all current assets are equally liquid, which leads us to another more specific ratio for measuring liquidity, which we're going to see here. As a general rule, a higher current ratio is better, but higher current ratios isn't always a positive signal. Companies can have difficulty collecting receivables or holding excessive inventory, which would give them a higher current ratio, but that's not always a good thing. Managers have to balance the incentive for strong liquidity, which would give us a higher current ratio, with the need to minimize levels of receivables and inventory. So management is responsible for being efficient with their resources and using them in the best manner. And having a bunch of money sitting in inventory and receivables is not necessarily a positive thing, even though that will account for a better liquidity. Now, this is one of the ratios that is liquidity. It's called the acid test ratio, or sometimes it's called the quick ratio. It's similar to that current ratio, but it's more conservative because it is a measure of current assets available to pay current liabilities. We calculate it by dividing what we call quick assets by current liabilities. Now, quick assets only include cash, current investments, and accounts receivable. By eliminating other current assets like inventory and prepaid expenses that are less readily convertible into cash, The asset test ratio may ultimately provide a better indication of a company's liquidity than would just the current ratio. Another key point, working capital is the difference between current assets and current liabilities. The current ratio is equal to current assets divided by current liabilities. The asset test ratio is equal to quick assets, cash, current investments, and accounts receivable divided by current liabilities. All of these measure the company's liquidity, and it's able to pay, as the liquidity meaning it's able to pay current maturing debts as they come due. Let's do one final question as we wrap this up. The current ratio is A, computed as the difference between current assets and current liabilities. B, computed as current assets divided by current liabilities. C, a measure of profitability. Or D, all of the above. It is computed as current assets divided by current liability. It is a measure of liquidity. It has nothing to do with profitability. Well, I hope that's helped you. Have a great day.